Hey, thank you all for coming. I do appreciate it. It's nice to see some real people. Exploration Insights, I'm no longer co-editor. I'm just an advisor to it. Joe Mazumder is the author, and he does a great job of it. What I want to do today, real quick, and I'm going to go through this rather rapid, the first part, is, in my view, the key to making money in this sector, if you're serious, is understanding what a company's looking for in terms of the geology and what it's going to take to make money, and then following the results to make sure that that thesis is holding up. As soon as that thesis falls apart, my experience has been sell regardless of how much you lose, because hope generally doesn't work in this sector. Real quick, what we're going to do, state of the industry, money, mining, exploration, due diligence. We'll talk about bus, tech studies, and some tips and tricks. Right now is a great time for the major miners. Their margins are big. They're generating $71 billion more or less in free cash flow. At $1,500, at $1,850, that goes up to $113 billion. Copper miners are also doing quite well. November through November of last year, $1.8 billion in 129 IPOs, $20 billion in equity, a bunch more in the battery sector. Canadian financings last year, about $5 billion hard, 1.7 flow through. And on an enterprise value to free cash flow basis, the gold miners are selling at historically cheap levels. So what are they doing with all that cash? Last year, in the order of $10 billion exploration budget, 38% mine site, late stage, and a bit on grassroots. What we like to focus on at Exploration Insights is grassroots or very high quality new discoveries. And you can see most of the money goes into gold, then copper, and nickel and battery metals have taken up a lot more money over the past couple of years. And how's that exploration going? How's that $10 billion going? Well, by and large, regardless of the money being spent, discoveries, and what I mean by discoveries, I'm looking at economic discoveries, not just pie-in-the-sky uneconomic anomalies is what we really call them. It's going down, and that's been going on for quite a while. And there's a lot of reasons for that. I would say, by and large, it's just we've covered most of the earth and found most of what's easy. Now we're looking undercover, in new environments, in more difficult places. And it takes so much more time once, just to permit an exploration project and then move on to permitting a mine and the environmental factors. Anyway, it takes much, much longer now to make and develop a discovery. And although there have been some recent discoveries that aren't on this, it's still the same picture. We are not finding enough gold or copper, etc., to replace what's being mined. I mean, keep in mind that we're mining through 90 plus million ounces of gold a year. That's about how much has been pulled out of the Carlin Trend. And we're going through 15 billion tons of copper, which is about what's been pulled out of Bingham Copper Mine. So we've got to find and put one of those into production every year to stay even. It ain't happening. And what do they need to find? This is really key. This chart shows enterprise value to total mineral inventory by grade. And the red ones up there, those are the high-grade deposits. And those are all the highly valued companies. So what a company needs to find is not a low-grade marginal deposit. They need to find the higher grade, high margin. And when I say high grade, I mean high margin. There's a lot of high-grade deposits that don't make money. All right. I like this chart. What it shows in the light brown are projects that are actually in production and what their all-in sustaining costs are versus the grade of their proven and probable reserves. What you'll see is that the current deposits in production all sit up in the 1,000 to 1,500 all-in sustaining costs per ounce. The ones in light blue are the ones that have not been built. These are from pre-feasibility studies. And I find it remarkable that the ones that haven't been built are better on paper. The ones that are built, the kinks have been worked out, etc. I guess what I'm getting to is that don't buy it. And okay, so primary reasons for bust. There's a lot, but number one is the resource estimate. It is very difficult. I mean, consider you're looking at a drill hole about yay big and assaying half of that, and then you get down to a 30-gram sample, which actually gets assayed for gold. That little bit of material over 1 meter is often projected across clear to the other side of the room, or halfway across the room, and so you're interpolating something that's that big halfway across this room. So there's a lot of room for error and guessing, and it takes some real detail to do it. So that's probably the biggest reason we see busts. Dilution, that's a big problem as well. Lots of, between here and the end of that room, if you throw in 3 or 4 barren blocks of rock and don't catch that, your resource grade goes down. Unrealistic technical studies, there's a lot of those. Social environmental issues, that's obvious. Easy money. The guys racing the money at the banks, the buy-side analysts, that's how they make their money. So they're incentivized, I think, to be a little more positive than they probably should be. And here's a short list of disasters. I won't go through them all. You can add yours to that if you like. Yeah, you can take a picture. All right. Unrealistic economic studies. Let's look at one, in my opinion. Spanish Mountain Resources. They've got a deposit up in BC. A pre-feas study in 2021 showed an NPV of $655 million. IRR 22%. There's your CapEx. They've got 2.3 million ounces of M&I at a recovered grade of 0.63 grams a ton. That's a recovered grade of 0.63 grams per ton. It's a sulfide deposit. It's irregular. It's a bit nuggety. There's some carbonaceous material in it. Anyway, their all-in sustaining costs are in the order of, what does I say here? Call it $650 an ounce. And I plot that, the blue, against the average cost for the small producers, the medium, and the large producers. This is unrealistic, and again, in my opinion. And this is what an unrealistic deposit looks like. And I've thrown Sprott on there when he put money in at 45 cents. Not to say this guy doesn't know what he's doing. He's got more money than all of us combined. But it's generally not a good idea, in my view, just to follow someone blindly without knowing what their game plan is. And his game plan is spread money all over the place. Most are going to lose. He's going to get a few real big winners, and he makes money that way. That's not how I can afford to do it. All right, what can you tell from a drill pattern? This is Go Gold's drill pattern on their deposit down in Mexico. And all the dark lines are the drill holes. The brown are the veins. And you can see that the drill is consistent. They found the vein, they know where it's going, they understand the geology, and they're just drilling it off like that. That's very simple and very straightforward. And that is what a good deposit looks like, except the past week. All right, now what does this drill pattern tell you? This is a company called Sirius. And what's shown on there is the pink is kind of a granite and the blue is a metasediment. All those lines, the darker ones, the more recent drill holes, the lighter ones are older drill holes, but it looks like a pin cushion. What that's telling me is they really don't have any sense of what's happening here, what's controlling the mineralization, and it's fracture controlled. It goes in all directions, and there's pods and such to it. Anyway, that tells you a lot about the deposit they're drilling and then how they understand it. And they put out some nice drill holes, 80 meters at 3 grams, 16 at 3.9. 1.1 and 97. And that's the other thing that keys me in. If you see a news release and there's 80 meters of a gram and the next drill hole is 2 meters of 20 grams, what is this thing? Is it a big bulk mineable deposit or is it a high-grade vein deposit? It's kind of got to be one or the other. And that's what that looks like. Grade smearing. I've harped on this for a long time. Most of you probably heard this, but what that means is a company will hit a high-grade interval and take that and mathematically spread that across a much longer drill interval, which can make it seem like that long interval is all minerals, when in fact it's this one meter interval or whatever that carries it. In this example, free gold intersected 573 meters of 1.21 grams a ton. That's a pretty damn good drill hole, but it included 3 meters at 131 grams, which occurred at 580 meters depth as well. From the Exploration Insights website, you can link to this drill hole interval calculator and plug these things in. And when you do that, you put in the big interval, 573 meters at 1.21. You pull out the 3 meter interval at 131, and your residual grade for the entire west of that 570 meters is 0.53 grams a ton. Way different, right? Way different perception of what they've got. Okay, and I got a spectacular drill hole. Doesn't make a deposit. No, there are a bunch of them. And this is a project down in Colombia that I visited many years ago. And they drilled another 270 meters at 1.23 grams, 217 at 1.4. Very, very nice hits. But what you want to look at is the setting, the context. So this is a body that sits sort of like this, in a bit of a valley with a bunch of barren rock to it. That dark gray is the mineralized thing. Everything else is waste. So your strip ratio to get to that, meaning the amount of barren rock you've got to pay to move to get to the mineralization, just kills this thing. And they ended up with a resource 1.4 million ounces at 1.1 gram a ton. And that's what that looks like. You see the early excitement? I should point out that Gold Mining Inc., this is one of their resources they claim in their presentations and such. It doesn't make money, nobody mind. Unrealistic targets, I like this one. RT Minerals, many years back, was going to drill underneath a lakeshore vein. And their target, their concept, if you will, was to hit this vein at 3.4 kilometers beneath the vein at surface. All right. Someone gave him $4 million. The target is the width of a sidewalk, good sidewalk. Let's pretend they do succeed. What's it going to cost them to drill the next hole? What's it going to cost them to get a resource on a vein when you've got to consider they probably need 25 meter centers to pull a resource out of this, drilling these holes. If they're successful, what are the production costs? It just doesn't make sense. And I see this way too often, is that even if a company is successful, it doesn't matter. And for reference, there's your drill hole, and I've done a sketch of that from this building, 3.4 kilometers that direction. You end up on West 10th Street. That's how far they were drilling. I mean, and advised by they didn't find anything. Narrow high-grade veins. What I'm showing here is, in blue, we're pointing to the quartz veins where the mineralization is. The green line is what's going to be mined, the mining width, if you will. What you want to see is good grade continuity and the mining method, etc. So I've used this before too, but I think it's important to keep in mind. Again, the blue is the ore, the vein. The green is the mining width, which has no gold in it, so that's waste. And there's really two kinds of rock. There's ore, which makes money, and waste, which loses money when you're mining. So if you take this 1 meter wide, 1.5 meter wide vein at 10 grams a ton, throw in your mining width, which brings it up to 3 meters, your grade goes from 10 to 5 grams immediately. And that's what you're processing. And if you start throwing in internal waste, it gets worse. This is what the problem that Pure Gold had. Rubicon, another mistake. Bad geology, very bad geology, bad continuity, etc. All right, this is the Eleanor deposit that Goldcorp bought from Virginia. And I want you to look at the black lines are the drill holes into this thing. And the red is where they intersected mineralization. And the blue dotted dashed line outlines the ore shape that they interpreted from this data. And you can see that it kind of makes sense. But on further detailed work, it turned out that that was in fact a vein that had been bent and squished like that. So there's a whole lot of barren material in there, which means they've got to mine more waste, higher production costs, etc. And a much more simpler version of this is the indicated shape is a straight vein, right? But when they got in and measured in more detail, I drilled more detail, the updated mineral shape is like this. And what that meant is that it added 60% more tons, a bit more ounces, but 25% less grade due to the mining method they had to use that. So this makes a huge difference in what a mine's worth. All right, this is a composite, I call it Where's Waldo. Everything in red is a deposit type, a mineralization type that can occur associated with a intrusive in the Andes or something. I'm running out of time here, but this is the reality of it. This is from the backside of the Andes, another project I looked at. It's not that easy to figure these things out. And here's a picture of the Andes. Each one of those little stars is a volcanic center, and there's some alteration with it. Each one could be a deposit, but very few will actually be a deposit. But you've got to go look at these things. Another thing I've seen quite a bit of is where the surface sampling does not reflect what's beneath. A lot of times you get a vein or a breccia like this on a hillside, and it forms a hillside. Your surface sampling is fantastic, but beneath it there's nothing. And this one was really obvious, as all their sampling stayed up there. When I went and looked at this, the question is, why didn't you sample beneath there? I think they knew what was there. Nothing. Here's one I like. 40 meters of 5 grams trench across this thing. What the hell are you going to do with that? If it's a deposit, that river floods every monsoon season. There's no place to put the mill. It's just, it's not going to work, regardless of the grade. So why bother with science and due diligence? Easy. Bingo. Bam. Bingo. All right, so summarizing. This is what we do at Exploration Insights. This is what Joe does. You know most of these are going to fail, so you want to find the fatal flaw as quick as possible and get out. Know the funding requirements. What's it going to take to move this thing forward? Know what the go, no-go points are. What does the company need to prove to you to validate the theses, that they've got something of value? What's it going to cost to build the mine they think they're going to have? Know the geology, social and environmental limits. Is success meaningful? That's really important. So many companies are out there looking for something that, even if they're successful, it doesn't matter. The share price doesn't go anywhere. And that's what we're really here for, is an increased share price. So, if you don't want to do all that work, you can subscribe to Joe's newsletter, and he does it for you. Exploration Insights. It's about what he is buying with his money. No one pays him to say anything. He might be paid to not say things. And myself. There's on the website, there's lots of information, there's videos, there's a few reports. So that's it, Exploration Insights. Thanks so much for your time and good luck.